Welcome to a comprehensive exploration of how Treasury management practices impact a firm's liquidity and profitability. Treasury management is a vital aspect of any organization's financial strategy, and understanding its influence is crucial for businesses aiming to achieve long-term success. In today's business environment where financial stability and profitability are paramount, Treasury management plays an indispensable role. It involves managing the company's financial resources in a way that ensures maximum liquidity, mitigates financial risks, and optimizes overall profitability. This deep dive will not only cover the fundamentals of Treasury management, but also delve into its strategic implications for a firm's financial health. Understanding Treasury management, a core component of financial strategy. Treasury management, at its core, is about the efficient and effective management of a company's cash flows, investments, and financial risks. It encompasses a wide range of activities including cash flow forecasting, liquidity management, risk assessment, and investment strategies. Each of these activities is crucial in determining how well a firm can meet its financial obligations and capitalize on growth opportunities. The primary objectives of Treasury management are to ensure that the company has enough liquidity to meet its short-term obligations and to optimize the use of its financial resources to generate profits. This requires a delicate balance between maintaining sufficient liquidity and investing excess cash in ways that contribute to the company's profitability. The crucial role of liquidity in business operations. Liquidity is often described as the lifeblood of a business. It refers to a company's ability to quickly convert its assets into cash to meet its short-term obligations. A firm with strong liquidity is well positioned to handle unexpected expenses, take advantage of sudden investment opportunities, and avoid financial distress. Effective Treasury management practices are essential for maintaining optimal liquidity levels. One of the most important practices is accurate cash flow forecasting. By predicting cash inflows and outflows with precision, a company can ensure that it has the necessary funds available when needed. This proactive approach to managing liquidity allows firms to allocate resources more efficiently, respond swiftly to market changes, and reduce reliance on external financing. In addition to cash flow forecasting, working capital optimization is another critical aspect of liquidity management. This involves managing the company's receivables, payables, and inventory in such a way that it minimizes the amount of cash tied up in operations. By streamlining these processes, a company can free up cash that can be used for other purposes, such as investing in growth opportunities or paying down debt. Linking liquidity to profitability, a strategic approach. Profitability is the ultimate goal of any business, and effective Treasury management is key to achieving it. While generating revenue is important, profitability also depends on how well a company manages its financial resources. By prioritizing liquidity, Treasury management not only helps prevent financial crises, but also positions the company to seize opportunities that can enhance profitability. A robust liquidity position allows a company to make strategic investments that can drive growth and increase profits. For example, a company with strong liquidity can invest in new technologies, expand into new markets, or acquire other businesses. These investments can lead to higher revenues and, ultimately, greater profitability. Moreover, effective Treasury management can help reduce costs and improve efficiency. By optimizing working capital, managing cash flows proactively, and investing excess cash wisely, a company can lower its cost of capital and increase its return on investment. This, in turn, contributes to higher profitability and a stronger financial position. Key Treasury management practices that enhance liquidity and profitability. There are several Treasury management practices that are particularly effective in enhancing both liquidity and profitability. These practices include cash flow forecasting, working capital optimization, and investment management. 1. Cash flow forecasting. Accurate cash flow forecasting is critical for managing liquidity effectively. By predicting cash inflows and outflows with precision, a company can ensure that it has the funds available when needed. This proactive approach helps avoid liquidity shortfalls and allows the company to allocate resources more efficiently. 2. Working capital optimization. Working capital optimization involves managing a company's receivables, payables, and inventory in such a way that it minimizes the amount of cash tied up in operations. By streamlining these processes, a company can free up cash that can be used for other purposes, such as investing in growth opportunities or paying down debt. 3. Investment management. Investment management is another important aspect of treasury management. By strategically investing excess cash, a company can generate additional income and further boost profitability. This may involve investing in short-term securities such as Treasury bills or commercial paper that provide a safe return on investment. Challenges in treasury management. Navigating uncertainty. While treasury management offers numerous benefits, it also comes with its own set of challenges. These challenges include market volatility, interest rate fluctuations, and geopolitical events, all of which can significantly impact treasury operations. 1. Market volatility. Market volatility can pose a significant challenge for treasury management. Fluctuations in asset prices, exchange rates, and interest rates can impact a company's cash flows and liquidity. For example, a sudden drop in the value of a foreign currency can reduce the value of a company's overseas revenue, leading to a liquidity shortfall. 2. Interest rate fluctuations. Interest rate fluctuations can also have a major impact on treasury management. Changes in interest rates can affect the cost of borrowing, the return on investments, and the value of financial instruments. For example, an increase in interest rates can raise the cost of debt, reducing a company's profitability. 3. Geopolitical events. Geopolitical events, such as trade disputes, political instability, and natural disasters, can also impact treasury management. These events can disrupt supply chains, affect currency exchange rates, and create economic uncertainty, all of which can impact a company's liquidity and profitability. Effective risk management, a critical component of treasury management. Given the challenges of market volatility, interest rate fluctuations, and geopolitical events, effective risk management is a critical component of treasury management. By implementing strategies such as hedging and diversification, a company can protect its liquidity and profitability from these risks. 1. Hedging. Hedging is a strategy used to protect against the risk of adverse price movements in financial markets. For example, a company that expects to receive payments in a foreign currency may use a forward contract to lock in the exchange rate, thereby protecting itself from currency fluctuations. 2. Diversification. Diversification is another important risk management strategy. By diversifying its investments across different asset classes, industries, and geographic regions, a company can reduce its exposure to any single risk. This helps to protect the company's liquidity and profitability from market volatility and other risks. The future of treasury management. Embracing technology and innovation. As the business environment continues to evolve, so too must treasury management practices. In recent years, there has been a growing emphasis on leveraging technology and innovation to enhance treasury operations. 1. Automation and digitalization. One of the key trends in treasury management is the increasing use of automation and digitalization. By automating routine tasks, such as cash flow forecasting and payments processing, companies can improve efficiency, reduce errors, and free up time for more strategic activities. 2. Data analytics. Another important trend is the use of data analytics to enhance Treasury decision-making. By analyzing large volumes of data, companies can gain insights into their cash flows, liquidity needs, and investment opportunities. This can help them make more informed decisions and improve their overall financial performance. 3. Blockchain and distributed ledger technology. Blockchain and distributed ledger technology are also starting to play a role in Treasury management. These technologies can improve transparency, reduce the risk of fraud, and streamline processes such as payments and settlements. Conclusion: the strategic importance of Treasury management. In conclusion, the impact of Treasury management on a firm's liquidity and profitability cannot be overstated. By adopting robust Treasury practices, companies can navigate financial complexities, enhance their operational resilience, and ensure sustainable growth. Effective Treasury management is not just about managing cash flows and liquidity. It is about taking a strategic approach to financial management that supports the company's long-term goals. By prioritizing liquidity, optimizing working capital, and managing risk effectively, companies can achieve both financial stability and profitability. Thank you for joining us on this in-depth exploration of Treasury management. We hope this discussion has provided valuable insights into the importance of Treasury management in today's business environment. Don't forget to subscribe for more expert insights into financial strategies that drive success.